What if I told you that while you were asleep on a Sunday night in December 2025, a metal that most people don't even think about quietly shattered a resistance level that had held for 45 years? Not broken, shattered. And the banks, the same institutions that had spent billions of dollars betting it wouldn't, woke up on Monday morning to a financial reality their models said was impossible. Now, here's the part that gets interesting. Because within hours of that breakout, the internet exploded with a story, a viral story, one with a very specific time, 2:47 a.m., a very specific number, $2.3 billion, and a very specific claim that a major Wall Street bank had been quietly liquidated. While you slept, was any of that true? Some of it was, some of it wasn't, and the parts they got wrong are just as revealing as the parts they got right. Today, we're going to go through this entire event, tick by tick, margin hike by margin hike, and we are going to separate what actually happened from what the internet wanted to have happened. Stay with me, because by the end of this video, you'll understand how a commodity that most Wall Street banks valued at $26 a year ago hit $121 per ounce. You'll understand exactly who got destroyed. And you'll understand why the physical market and the paper market are now telling two completely different stories. Let's get into it. To understand why this breakout was such a seismic event, you need to understand one number, $50. For 45 years, $50 per ounce was the absolute ceiling of the silver market, not a rough target, not a general area of resistance, a ceiling, the kind that gets tested, holds, and sends prices crashing back down twice across 5 decades. The first test came in January 1980. Two brothers, Nelson and Bunker Hunt, attempted to literally corner the global silver market by buying up physical supply. They drove silver to an intraday peak of $49.45 per ounce. The exchange responded by banning new long positions. The market collapsed 80% within weeks. The second test came in April 2011. Post-financial crisis money printing flooded into commodities. Silver surged to $49.80 per ounce. The CME Group raised margin requirements 5 times in 9 days. The market collapsed 30% in weeks and entered a decade-long bear market. 2 attempts, 2 failures, both stopping just cents below $50. Technical analysts will tell you that the longer resistance level holds, the more violent the eventual breakout becomes. 45 years of ceiling pressure, tested twice, create a coiled spring of enormous energy underneath it. And in October 2025, that spring broke. What shattered the ceiling wasn't speculation. It was something that didn't exist in 1980 or 2011. A structural, industrial physical deficit driven by solar panels, electric vehicles, and AI data centers consuming silver faster than the world can mine it. 6 consecutive years of deficit. Over 760 million ounces drawn from above-ground stocks. The physical market had been bleeding supplies silently for years, and in late 2025, that bleeding finally showed up in the price. When you see a breakout above a multi-decade resistance level, particularly one backed by real industrial demand, the historical pattern says one thing. The price doesn't find new resistance quickly, because there is none. The market enters what traders call price discovery. No map, no ceiling, just momentum and physics. That is exactly the environment silver entered in late 2025, now that we know why the breakout happened. The next question is how it played out in real time, including some very suspicious events on Thanksgiving night that most mainstream outlets completely ignored. It's 9 p.m. Eastern Time on Thursday, November 27th, 2025, Thanksgiving Day. The U.S. equity markets are closed. Most trading desks are running skeleton crews. If that, families are sitting down to dinner. And on the COMEX, something extraordinary is happening. March 2026 silver futures are surging toward $54 per ounce, a level that, as we just established, the market hadn't seen in 45 years. The order book on the sell side is running dry. Institutional short sellers are staring at positions that are going deeply, rapidly underwater. And then, at exactly 9:44 p.m. Eastern Time, everything stops. The CME Group halted all electronic trading on its Globex platform. The official explanation, A catastrophic cooling system failure at the Cyrus 1Chi1 data center in Aurora, Illinois, the co-location facility that hosts CME's primary database servers. The outage lasted 10 hours and 46 minutes. Now, on the surface, that sounds like a routine technical disaster. Data centers fail. Cooling systems malfunction. Except here's the detail that nobody picked up. On the night of November 27, 2025, the outdoor temperature in Aurora, Illinois was in the mid-20s to low 30s Fahrenheit. Modern enterprise-grade data centers, at the scale that Cyrus One operates, are built with what are called free cooling economizers. These systems automatically bypass mechanical chillers and cool servers using cold outside air when temperatures drop below 30 degrees Fahrenheit. In other words, on the exact night the cooling system allegedly failed, the outdoor conditions were ideal for the backup free cooling system to engage automatically, without needing the mechanical chillers at all. The complete failure of multiple redundant cooling systems under those conditions has never been fully and publicly explained by either Cyrus One or the CME Group. There's more. While COMEX futures were frozen for nearly 11 hours, over-the-counter spot silver markets in London and Zurich kept trading. And within minutes of the halt, spot silver fell by $1 per ounce under thin holiday liquidity, allowing institutional market makers to quietly reprice their physical hedging books without facing the risk of a catastrophic vertical price gap on the futures exchange. Simultaneously, commercial banks borrowed $24.4 billion from a Federal Reserve standing repo facility. And here's the detail that should make your eyebrows go up. The submitted bid amount exactly matched the accepted amount to the dollar. In repo auctions, that near-perfect match is statistically rare and points to a prearranged emergency balance sheet transaction for a specific participant under acute stress. I want to be clear. There is no direct documented evidence that the CME outage was engineered. Cyrus One and the CME have official documentation of a legitimate compressor failure. But when you stack the anomalies, cooling failure under ideal free cooling conditions, the immediate OTC price drop during the halt, and the exact match repo bid, the sequence of events is suspicious enough to be worth knowing. Draw your own conclusions, but make sure they're informed conclusions. The Thanksgiving outage was just the opening act, because what happened over the following 4 weeks, in the vaults, in the margin accounts, and on social media, is where this story gets truly extraordinary. After the Thanksgiving halt, silver didn't collapse. It regrouped. By late November and into December 2025, the market was in a different mode, not speculative momentum, something more structural, something more alarming to the banks. Physical delivery. When a futures contract expires on the COMEX, the buyer has a choice: settle in cash or take physical delivery. In most conditions, nearly everyone settles in cash. Physical delivery is inconvenient. You need to arrange vault storage, certify bars, logistics. But in late 2025, a wave of contract holders said, "Give me the metal." Between December 1st and December 4th, 2025, a window of just 4 trading days, 47.6 million ounces of physical silver were claimed and withdrawn from COMEX registered vaults. That represented nearly 60% of all registered deliverable inventory on the exchange. Read that again. 60% of the deliverable physical silver on the most important commodity exchange in the world, gone in 4 days. This triggered what's called a backwardation event. Normally, futures prices trade above spot prices because of the cost of storage and financing. When that relationship inverts, when spot trades above futures, it signals something deeply wrong with physical supply. The market is screaming, "We don't have the metal." Physical lease rates, the interest rate that entities pay to borrow physical silver bars, spiked to 19% per annum during the run-up and then surged further to 35%. For context, in a normal, well-supplied market, precious metals lease rates sit between 1% and 2%. A spike to 35% means financial institutions holding paper liabilities backed by silver were desperately bidding for physical bars to make good on delivery obligations. They didn't have the metal, and the market knew it. The COMEX vault withdrawal number is the single most important data point in this entire story. Everything else, the price action, the margin hikes, the social media rumors, is noise around that core signal. When 60% of deliverable inventory exits a vault in 4 days, the paper market and the physical market are no longer the same market. They're running two different prices for the same thing. And eventually, one of them has to be wrong. And so we have a vault being drained, a market in backwardation, and banks sitting on short positions they can't cover. That sets the stage for the weekend that broke the internet. And the viral story that was half true, half fabricated, and entirely misunderstood. Friday, December 26, 2025. After the close of business, on the day after Christmas, a day when almost nobody is watching, the CME Group quietly issued advisory number 25 to 393, effective after close on Monday, December 29th. Initial margin requirements for March 2026 silver contracts were raised from $20,000 per contract to $25,000, a 25% increase. Overnight. Now, for context, margin is the money you have to put up to hold a futures position. When exchange raises margin requirements, highly leveraged traders, those holding positions with minimal cash reserves, face a choice: deposit more money or liquidate. If they can't find the cash, they get liquidated automatically. This is by design. It's the exchange protecting itself. But what happened next was not by design. Over that same weekend, Saturday into Sunday, December 28th, a story exploded on social media platform X. According to viral posts, a systemically important Wall Street bank had failed a $2.3 billion margin call at 2 a.m. on Sunday morning. The forced liquidation, the post claimed, occurred at exactly 2:47 a.m. And to prevent a systemic banking collapse, the Federal Reserve had injected a secret, emergency $34 billion bailout. Also on Sunday morning, the story spread to hundreds of thousands of people within hours. Here's the structural problem with that story. The COMEX does not process margin calls on Sunday morning at 2:47 a.m. The exchange is closed. Sunday clearing runs don't exist. Forced liquidations of futures positions don't happen on weekend mornings when global electronic markets are inactive. The pre-market clearing cycle runs on Monday morning, not Sunday night. Furthermore, the Federal Reserve's transaction ledger for that period shows no emergency Sunday injection. What to happen were standard, seasonal, year-end repo operations. $17.25 billion on Friday, $25.9 billion on Monday, both completely in line with historical year-end seasonal ranges, driven by banks managing their regulatory balance sheets heading into the new year. But here's why the rumor was so compelling, and why it spread so fast. The underlying conditions it described were real. Banks were in acute distress. Physical inventory had been drained. Short positions were underwater by billions. The rumor took real structural stress and wrapped it in a Hollywood narrative. A specific time, a specific dollar amount, a secret government bailout. Because that narrative was more emotionally satisfying than the boring, complicated truth. The rule for navigating financial information on social media is simple. When a story has suspiciously precise details, an exact time, an exact dollar figure, a secret government action, those details are almost always invented. Real market crises are messy, ambiguous, and often don't resolve in a single dramatic moment. Be skeptical of financial drama that arrives pre-packaged with a timestamp as, oh, the Sunday night bank collapse story was false. But that doesn't mean the banks escaped unharmed. Far from it. Let's talk about the verified, documented evidence that institutional desks were caught completely flat-footed, and what that looked like in practice in the investment world. A 10% forecasting error is embarrassing. A 20% error is a bad year. A 215% error means your model doesn't just need adjusting. It needs to be thrown in a trash can and rebuilt from scratch. That is what happened to Bank of Montreal in 2025. BMO's commodity research desk entered 2025 with an official silver price target of $26.50 per ounce. Silver peaked at $83.64 per ounce. That is a 215% forecasting miss, the widest on Wall Street. But they weren't alone. Citigroup entered 2025 with a target of $32 per ounce, then revised to $38, then $40. Then eventually conceded a floor of $70 for 2026. JP Morgan was forced to raise its 2026 average price forecast by 44%. to $81 per ounce, explicitly acknowledging that the scale of the rally had broken their historical spreadsheet and mean reversion models. Goldman Sachs and HSBC executed similar revision cascades. These aren't small shops with limited resources. These are the most sophisticated financial institutions in the world, with armies of analysts and billions of dollars of computing power. How do they miss a 150% move in a major commodity? The answer is that their models were built on the wrong premise. They modeled silver as a monetary metal, a speculative asset that rises with inflation expectations and falls when real yields go up. What they failed to model adequately was the industrial demand picture. Solar panels alone consumed a record amount of silver in 2025, driven by an irreversible global energy transition. EV manufacturers, AI data center power infrastructure, medical devices. Demand was compounding across sectors that weren't part of the traditional silver demand framework. There's also a verified, real trading loss on record. On October 16, 2025, TD Securities disclosed a trading loss of $2.39 million while unwinding a failed short position in silver. That number sounds modest relative to the scale of the market, but it's documented evidence that institutional short sellers were being forced out of positions as the rally accelerated. When the most sophisticated forecasting machines in the world miss a move by 215%, the lesson isn't that the banks are incompetent. The lesson is that mean reversion models fail completely when a structural commodity market shift is underway. If your analytical framework doesn't include physical supply deficits, you're looking at the wrong data. Banks caught off guard, vaults drained, margin calls cascading. This all builds toward one final, extraordinary moment. January 29th, 2026. The day silver hit $121 per ounce. And then the day after, when all came apart that on January 29th, 2026, silver hit $121.67 per ounce. Let that sink in for a moment. A year earlier, the same metal was trading at $29 per ounce. In 12 months, it had run over 300%. And then 24 hours later, it was at $78.53 at January 30th, 2026. Became the worst single trading day for silver since March 1980, a 31.4% single session collapse. Several things converged simultaneously. First, the CME Group had already implemented a second consecutive margin hike to $32,500 per contract, up 62.5% from its pre-crisis level. This drained enormous leverage from the market. Second, the nomination of Kevin Warsh as Federal Reserve Chair sent the U.S. dollar index surging and bond yields sharply higher, a classically bearish macro combination for commodity prices. Third, and this is a detail that generated serious suspicion, Reuters published an exclusive report claiming the U.S. Department of Energy was backing away from plans to guarantee floor prices for critical minerals. Algorithmic trading systems read the headline and triggered automatic sell orders across the CME, driving silver through key support levels in minutes. Hours later, the U.S. Department of Energy issued a formal statement declaring the Reuters report false and deliberately misleading. The denial came after the market had already crashed. Two possibilities exist. Either Reuters made a catastrophic editorial error on one of the most market-sensitive stories of the year and failed to verify the information before publishing, or the false report was deliberately placed to trigger algorithmic stop-loss cascades at critical technical level, allowing someone to cover short positions at the exact intraday low of $78 per ounce. There is no documented proof of the latter. But the sequence of events, false report, algorithmic crash, DOE denial after the damage was done, is one of the most unusual sequences of the entire episode. Here's what's critical, though. The paper crash did not fix the physical market. U.S. and Canadian bullion dealers were reporting record physical demand and widespread dealer shortages by early February 2026. Retail premiums for Silver Eagle coins surged to historic highs over the paper spot price, reflecting a complete decoupling of physical reality from the derivatives exchange. BlackRock was forced to amend the prospectus for the SLV Silver ETF, inserting an unprecedented risk disclosure warning that authorized participants might not be able to acquire sufficient physical silver to create new shares, potentially forcing a suspension of share creation. An ETF that might not be able to buy the thing it's supposed to hold. That is not a normal risk disclosure. The 31.4% crash on January 30th looks, on a chart, like the end of the story. But physical deficits don't disappear because a derivative price crashes. The World Silver Survey for 2026 documents a physical deficit of 46.3 million ounces for the full year, and a 6-year cumulative deficit of over 760 million ounces. The paper market can be reset by a margin hike. The physical market cannot, and so let's do what the internet failed to do. Separate the verified from the speculative. What is confirmed? Major global banks were demonstrably and badly mispositioned. Their forecasting models failed completely. The COMEX registered vault lost 60% of its deliverable inventory in 4 days. Physical lease rates hit 35%. BlackRock inserted an unprecedented risk warning into its silver ETF. TD Securities disclosed a documented trading loss on silver shorts. The CME raised margins by 62.5% in a single week. The same playbook used in 1980 and 2011 to kill a squeeze. What is not confirmed? No systemically important bank was liquidated on Sunday, December 28th at 2:47 a.m. No $34 billion emergency Sunday bailout exists on the Federal Reserve's ledger. The CME cannot and does not process forced liquidations on a Sunday morning. These specific claims are structurally false. What remains genuinely unexplained? Why did a state-of-the-art enterprise data center fail its cooling systems on a cold night when free cooling economizers should have engaged automatically? Why did OTC spot silver drop immediately when COMEX futures froze? Why did the repo bid match the accepted amount exactly? And why did a Reuters report that caused a historic market crash turn out to be false? These questions don't have confirmed answers, but they deserve to be asked. Here's what history tells us about moments like this. In 1980, the exchange changed the rules mid-game to stop the Hunt brothers. Silver collapsed 80% and entered a multi-decade bear market because there was no structural physical shortage underneath the speculation. In 2011, 5 margin hikes in 9 days killed the speculative bubble. Silver collapsed 30% and consolidated for a decade. Again, because there was no structural physical shortage underneath the speculation. In 2025 to 2026, the CME used the same tools, 2 margin hikes, a data center outage, a macro catalyst, and achieved the same short-term result, a 31.4% crash. The critical difference this time, the physical deficit is real. It has persisted for 6 consecutive years. It is being driven by irreversible green energy and technology manufacturing demand. The paper price can be reset by leverage removal. The physical supply shortage cannot be resolved by a margin advisory. Whether that means a paper reset is temporary or permanent is a question that every silver investor and every bullion bank is now trying to answer. You now know what actually happened in the silver market between late 2025 and early 2026. You know which claims were verified, which were debunked, and which remain genuinely suspicious. You understand the mechanics, the margin hikes, the vault drawdowns, the gamma squeeze, the false Reuters report. But here's the question that this entire episode leaves unanswered. If the physical deficit is real, if the world is consuming 164 million more ounces of silver per year than it's mining, what happens the next time a breakout begins? Are the margin hikes and exchange interventions a permanent solution, or just a pressure valve that buys time? That's exactly what I break down in the next video, where I go deep on the industrial silver demand picture, solar, EVs, AI data centers, and the one statistic about silver per photovoltaic cell that Citigroup is banking on to save the short thesis. It's the most important variable in this entire story, and most people covering silver have gotten it wrong. Link is right there. I'll see you in that one.